Sri, is this another regional banking crisis in the U.S.?
I want to be brave enough and stick my neck out and say no, and I'll tell you why. This is not the first regional bank to report during this earnings cycle. We've had a slew of reports, which were pretty uneventful, and that's how we like it. So this was the first big one where there was a problem. However, the big worry with these things is when you have a stock that's down 40% one day, another 10% the next day, has lost half its value, it shakes confidence in the market. And the risk is this can become a bit of a self-fulfilling prophecy. And that's when we start worrying about the broader issues. So far, the issues tied to New York Community Bank are tied to a bigger problem in the market, the commercial real estate market, that has hurt them in a very specific and particular manner. And there's another unique factor that is affecting this bank, the fact that it is a bit of a bigger bank. Funny reason, through the last regional banking tumult we had in the US, which was less than a year ago, NYCB was one of the winners. It managed to pick off a part of Signature Bank at a really good deal. They got it for a song from the regulators. Their stock doubled. Now it's trading less than the levels it was at last March, and that's why everyone's concerned.
But, Sri, what are you worried about? So if this is a trigger, and it's a little bit bigger than some of the other ones, is it the even smaller banks that are actually at risk here?
The numbers are important. So what is driving the problems at NYCB? We're talking about the increase in reserves in a way that the market did not expect. A big jump in the net charge-offs, another big jump in the cash that they had to stockpile for the loans on their balance sheet. That is because of the problems in the real estate market in the US, the office real estate market. The numbers that back this, by the end of next year, you will have $560 billion of maturities. At a time when the market's been rocked, office values have been sliding, and there are bigger factors behind this. The pandemic obviously jolted that market. You have a rapid zoom up in rates. You still don't have office occupancy to the levels that people would like, and everyone is rethinking their office footprint. What that means, unfortunately, is kind of what we saw in Los Angeles recently, where a building had to sell at almost half the value of what it was marked at in 2014, 10 years ago. That's not the direction you like. And when it comes to the office real estate market, it really does affect the regional banks, because almost 30%, 29% of the assets on their balance sheet are these real estate loans. That's not the case with the bigger banks. And that's why we're a touch concerned about the exposure of the real estate market, the CRE market, and the regional banks.
But do we know exactly where it is? Because this, I mean, the concern, we've been speaking about commercial real estate and the fact that something ugly could happen for, frankly, quite some time. So as long as we know the exposure, then as an analyst or a reporter, you know where you're looking. The problem is that if you don't.
And that's part of the challenge. You don't really know which landlord would look at what's happening with their loans, their challenge with refinancing their loans, and just simply choose to walk away. Some others will try and find some other options, and it becomes a bit of a game of whack-a-mole. You think you have it contained one area, and then suddenly it comes somewhere else. With New York Community Bank, it really was two big loans that they specifically flagged as the problem case here. When it's just two loans that can drive such a big, let's call it, lack of confidence in the market, then it's really hard to figure out where the next problem would come. You hope it's contained. You hope everyone is conservatively marking these loans, are appropriately reserved. But when you have a case like this, it does make you want to kick the tires and see where else the problems exist.
But so are you worried about some of the big banks, or would they have taken precaution in making sure that their exposure is handled?
As much as I hate to use a tired cliche, I still have to say it's unfortunately the reality is it is the tale of two cities. The big banks, with respect to their CRE exposure, it is just 6.5%. So that's 6.5% relative to 29%. Not nothing, but it is not almost a third of the assets on your balance sheet. So I am not that concerned that the big banks will get hit that much. Like, if the big banks are getting whacked by it, you've got a much bigger problem with the slew of the smaller banks that you have in the US.